Let me explain something about recessions that most investors never truly understand until it is too late. The problem is not that recessions are impossible to see coming. The problem is that most people are watching the wrong things. They wait for the stock market to collapse before they admit the environment has changed. They wait for the headlines to become terrifying before they begin thinking about risk. They wait until their portfolio is already bleeding before they ask what they should have done differently. And by then, the best decisions are usually no longer available. Most individual investors make one of two mistakes during recessionary periods and liquidity crises. The first mistake is panic. They sell everything at the worst possible moment. They turn temporary price declines into permanent losses. They abandon quality assets because they cannot emotionally withstand volatility. And then, after the dust settles, they spend years watching the market recover without them. The second mistake is almost the opposite, but just as damaging. They do nothing. They see the warning signs. They notice that something feels wrong. They know credit is tightening, liquidity is disappearing, and market leadership is weakening. But they remain fully exposed because changing a portfolio requires admitting that the world has changed. And that is very hard to do when your own money's involved. The investors who handle crises well are not the ones who perfectly forecast the future. Nobody does that consistently. The investors who survive and then compound through recessions are the ones who have a process before the stress begins. When that is the difference, not prediction, process. If you have no process, every crisis feels like chaos. Every headline feels important. Every rally feels like the bottom. Every sell-off feels like the end of the world. You become reactive, emotional, and vulnerable to exactly the kinds of decisions that destroy capital. But if you have a process, a crisis becomes something else. It becomes information. It becomes a sequence of signals. It becomes a test of liquidity, discipline, and preparation. And if you know what to watch, a recession or liquidity crisis does not have to be the event that destroys your wealth. It can become the moment that creates the best capital allocation opportunity of a decade. That is what I want to walk through today. Not a normal market correction, not a routine pullback, not a sector rotation. When I am talking about a true liquidity crisis, the kind of crisis where buyers disappear, credit markets tighten, forced sellers dominate price action. Margin calls spread from one asset class to another. High-quality assets get sold not because they are impaired, but because somebody somewhere desperately needs cash. In those moments, fortunes change hands. The question is whether you are the person being forced to sell or the person with liquidity available to buy. There are three signals I watch when trying to determine whether a real liquidity crisis is beginning. The first signal comes from credit markets. The second signal comes from the Federal Reserve and the interest rate structure. The third signal comes from forced selling and extreme positioning. If you understand these three signals deeply, not just as abstract financial concepts, but as practical tools for portfolio decisions, you will never look at recessions the same way again. Let us begin with the first signal. Stress in credit before the equity market fully understands what is happening. This is probably the most important point in the entire discussion. The stock market is not usually the first place where serious financial stress appears. Credit markets often know first. Equity investors love stories. They love earnings narratives, management guidance, new products, margins, market share, and long-term growth potential. Equity markets can remain optimistic for a surprisingly long time after the underlying financial system has already begun to weaken. Bond investors are different. Credit investors care about one thing above all else. Can the borrower pay? Or can the company refinance its debt? Can it generate enough cash flow? Can it survive higher funding costs? Can it roll over maturities when credit conditions tighten? That makes the credit market a much cleaner early warning system. When credit investors begin demanding higher compensation to hold corporate debt, they are telling you something important. They are not making a vague emotional forecast. They are repricing risk. The first part of this signal is credit spread widening. A credit spread is the extra yield investors demand to own corporate bonds instead of safer government bonds. When spreads are narrow, markets are saying that default risk is low and liquidity is abundant. Investors are comfortable reaching for yield. They are willing to lend to companies at relatively low premiums. When spreads widen, the message changes. The market is saying that the risk of default is rising. It is saying that investors want more compensation to own corporate debt. It is saying that balance sheets, refinancing conditions, and cash flow durability are becoming more uncertain. You want to watch both investment-grade spreads and high-yield spreads. Investment-grade spreads tell you what is happening in higher-quality corporate credit. High-yield spreads tell you what is happening in the weaker, more vulnerable part of the market. The high-yield market is especially important because lower-quality borrowers are usually the first to feel tightening financial conditions. They are more dependent on refinancing. They have less room for error. They are more exposed when liquidity disappears. When high-yield spreads begin widening in a sustained way, not just for a single day, but over several weeks, you should pay attention. That is often the bond market warning that economic conditions are deteriorating before the equity market has accepted it. The second part of the credit signal is stress in short-term funding markets. Most retail investors never look at these markets, which is exactly why they are so valuable. The repo market, the commercial paper market, overnight lending, bank funding rates, dollar funding conditions. These are the plumbing of the financial system. They are not glamorous. They do not appear on television every day. They do not produce viral headlines. But when these markets start malfunctioning, it tells you that trust inside the system is weakening. And when trust weakens in short-term funding, the consequences can move very quickly. In 2007, long before the full collapse of 2008, there were already signs of funding stress. Parts of the European short-term funding system began to freeze. Banks became less willing to lend to each other. Certain instruments that had previously been treated as safe and liquid suddenly became difficult to finance. The stock market did not immediately collapse. In fact, equities continued higher for a while. That is what makes this so dangerous. The warning signs can appear in credit and funding markets, while the equity market still looks calm. Then months later, the stock market finally catches up to what credit was already saying. That is why you do not want your primary warning signal to be the S&P 500 falling sharply. By the time that happens, the credit market may have been warning you for a long time. The third part of the credit signal is the leveraged loan and CLO market. And this is another area most individual investors ignore, but it is extremely important. Leveraged loans are loans made to companies that already carry significant debt. CLOs, or collateralized loan obligations, are structures that package these loans and sell different slices of risk to investors. When credit is easy, this market functions smoothly. Loans are issued. CLO managers find buyers. Risk appetite is strong. Institutions are willing to finance lower quality borrowers. But when the leveraged loan market starts to seize up, that is a major signal. If new issuance slows dramatically, if buyers disappear, if CLO managers struggle to place deals, if the senior tranches of new structures become difficult to sell, then deep institutional credit capital is stepping back. That matters because these are not casual investors. These are institutions that live inside the credit system every day. They analyze borrower quality, covenant protection, refinancing risk, leverage, liquidity, and default probability. When they become cautious, you should not ignore it. Some people will say, but spreads have been tight, issuance has been strong, credit has looked healthy for years. And that may be true. But credit often looks healthy right up until the moment it does not. The transition from calm to stress can be extremely fast. In fact, the longer the period of calm lasts, the more dangerous the unwind can become. Compressed spreads are not always a sign of safety. Sometimes they are a sign of complacency. When leverage is high, volatility is low, credit spreads are tight, and investors believe nothing can go wrong, the system becomes fragile. It does not take much to change the mood. And when the mood changes, the repricing can be violent. So the practical lesson from the first signal is simple. Watch credit every week. Do not just watch the stock market. Watch high-yield spreads. Watch investment-grade spreads. Watch short-term funding conditions. Watch leveraged loan issuance. Watch CLO demand. A particularly useful measure is the high-yield option-adjusted spread, which is publicly available through Federal Reserve data. You do not need expensive tools to track it. You need the discipline to look at it consistently. If high-yield spreads begin widening over multiple weeks, take that seriously. Credit often whispers before equities scream. Your job is to hear the whisper. Now let us move to the second signal, the Federal Reserve, the yield curve, and the difference between a policy pivot and a real recovery. This signal is more subtle because it requires understanding not only what the Fed is doing, but why it is doing it. Most investors misunderstand the Fed. They treat a Fed pivot as automatically bullish. They hear the word pause or cut and assume the danger has passed. That is one of the most expensive mistakes investors make during recessions. The Fed is not usually early. The Fed is usually late. That is not an insult. It is the nature of the institution. The Fed operates with lagging data. Inflation data is backward-looking. Employment data lags the cycle. Credit stress can build beneath the surface before it becomes visible in official statistics. The Fed also operates by committee. Committees tend to move slowly. They prefer consensus. And they avoid dramatic changes unless the evidence becomes overwhelming. This means the Fed often tightens too late when inflation rises and eases too late when the economy weakens. That lag creates risk, but it also creates opportunity if you understand it. The signal I watch is the shift in Fed language. At some point in every tightening cycle, the Fed begins to move from one concern to another. Early in the cycle, the concern is inflation. The Fed talks about price stability. It talks about keeping policy restrictive. It talks about labor market strength, demand, wages, and inflation expectations. In that phase, the Fed is trying to tighten financial conditions. That is generally negative for risk assets. But later, if stress begins to build, the language changes. The Fed starts talking more about financial stability. It becomes more careful. It starts acknowledging stress in banks, credit, liquidity, or funding markets. That change in language matters. It is often the first sign that the Fed is preparing to shift from fighting inflation to protecting the system. But here is the key point. The moment the Fed starts talking differently is not necessarily the moment to buy aggressively. A pivot in language is not the same as liquidity entering the system. A rate cut is not the same as a bottom. The first rate cut is often not a sign that things are fixed. It is a sign that conditions have become weak enough for the Fed to respond. That distinction is critical. In 2001, the Federal Reserve began cutting rates, but the equity market continued falling for a long time afterward. The Nasdaq ultimately suffered an enormous collapse. Much of the damage happened after the easing cycle had already begun. Investors who simply bought the first cuts suffered badly. Why? Because monetary policy works with long and variable lags. The Fed can cut rates today, but the economy does not heal tomorrow. Credit stress can continue. Earnings can keep falling. Unemployment can rise. Consumer spending can weaken. Defaults can increase. The market can rally on hope and then fall again when the real economic data keeps deteriorating. That is why you do not buy the pivot blindly. You wait for evidence that the pivot is beginning to work. The yield curve is one of the most important tools for this. Specifically, the spread between the 2-year Treasury yield and the 10-year Treasury yield. When the 2-year yield is higher than the 10-year yield, the curve is inverted. Historically, that inversion has been one of the strongest recession signals in modern financial data. It is not perfect. Nothing is perfect, but it deserves serious respect. However, the inversion itself is not usually the buy signal. The more important phase is when the curve begins to steepen after being deeply inverted. That steepening often tells you the market is beginning to price future Fed cuts, weaker economic growth, and a transition toward the next phase of the cycle. But even then, timing matters. A steepening curve can happen because long rates rise or because short rates fall. The reason matters. If short rates are falling because the market expects the Fed to cut aggressively due to economic stress, that can be part of the recessionary sequence. The second thing to watch is real interest rates. A real interest rate is the nominal interest rate adjusted for inflation. When real rates are deeply negative, borrowing is effectively subsidized. Money is cheap. Speculation grows, investors take more risk, asset prices rise, leverage builds. When real rates move sharply positive, liquidity is drained from the system. That is what happened after the period of extremely easy money ended. The move from negative real rates to positive real rates forces a repricing of almost everything. Growth stocks, real estate, private equity, venture capital, long-duration bonds, speculative assets, highly leveraged businesses, illiquid funds. The more an asset depended on cheap money, the more vulnerable it becomes when real rates rise. This repricing does not happen smoothly. It happens through stress, volatility, and forced adjustment. So the practical lesson from the second signal is this. Do not assume the Fed pivot is the bottom. Do not buy the first hint of easing simply because you want to be early. Watch the yield curve. Watch real rates. Watch credit conditions. Watch whether liquidity is actually returning to the system. The goal is not to catch the exact bottom. That is fantasy. The goal is to avoid being early in a way that is indistinguishable from being wrong. In a liquidity crisis, being too early can destroy capital almost as effectively as being completely wrong. Patience is not weakness. Patience is part of the process. Now let us move to the third signal, forced selling and extreme positioning. This is the signal that creates the opportunity. The first two signals tell you that danger is building. And the third signal tells you when the risk-reward may be shifting in your favor. Forced selling is different from normal selling. Normal selling happens because investors change their view. They believe an asset is overvalued. They think earnings will fall. They want to reduce risk. They are making a decision. Forced selling is not a decision. It is a requirement. A fund receives redemptions. A leveraged investor gets a margin call. A bank reduces exposure. A risk committee demands liquidity. A portfolio manager must raise cash immediately. And when that happens, they do not sell what they want to sell. They sell what they can sell. That is when markets become inefficient. You can recognize forced selling by its texture. The first sign is correlation going to 1. Assets that normally behave differently begin moving together. Stocks fall, gold falls, corporate bonds fall, emerging markets fall, high-quality companies fall, defensive assets fall, where everything gets sold at the same time. This is not because all of those assets suddenly have the same fundamentals. It is because the seller needs cash. In March 2020, even gold sold off sharply for a period of time, despite being viewed as a safe haven asset. That was not a rejection of gold's long-term role. It was forced liquidation. Institutions needed liquidity. They sold what had a bid. That is one of the clearest signs that the market is being driven by mechanics rather than fundamentals. The second sign of forced selling is when excellent assets fall for no specific reason. You see high-quality companies with strong balance sheets, durable cash flows, competitive advantages, and no negative news drops sharply in a single day. No earnings miss, no scandal, no regulatory issue, no change in the business, just selling. Why? That is often a sign that a large holder needs liquidity. In those moments, the market is not carefully distinguishing between quality and weakness. It is liquidating. This is where opportunity appears, because if the business has not changed, but the price has changed dramatically because of forced selling, the gap between price and value can become extremely attractive. The third sign is extreme positioning. One useful source is the Commitment of Traders report, published by the CFTC. This report shows how different groups are positioned in futures markets, including commercial hedgers, large speculators, and smaller traders. When speculative positioning becomes extremely bearish, especially in equity index futures, it can indicate that much of the selling has already happened. This does not guarantee a bottom. Nothing does. But when everyone who wants to be short is already short, the market becomes vulnerable to a reversal. The most bearish positioning often appears after the worst price damage has already occurred, when the headlines are terrifying, sentiment is broken, and investors can no longer imagine a recovery. That is often when the risk-reward begins to shift. This is the point in a crisis where preparation matters most. There is usually a moment when selling becomes irrational. Not at the beginning, not when the first warning signs appear, not when the first dip happens, but near the point of maximum pressure, when forced sellers dominate and high-quality assets are being sold simply because cash is needed. That is when the investor with liquidity has an advantage. And that brings us to cash. The financial industry does not like cash. A cash does not generate management fees. Cash does not look exciting. Cash makes people feel like they are missing out during bull markets. But in a liquidity crisis, cash is not laziness. Cash is power. Cash is optionality. Cash is the ability to buy when others are forced to sell. Warren Buffett understood this better than almost anyone. Berkshire Hathaway has often held enormous amounts of cash. During calm markets, people criticize that. They call it inefficient. They say the cash is dragging down returns. But when crisis arrives, cash becomes extremely valuable. In 2008 and again in 2020, Berkshire was able to act from a position of strength because it had liquidity when others needed it. That is the point. You do not hold cash because you are confused. Yes, you hold cash because you want the ability to be aggressive when the odds are finally in your favor. The assets that tend to hold up best in liquidity crises follow a recognizable pattern. Short duration, high-quality fixed income can preserve capital. Treasury bills and short-term high-quality bonds can provide liquidity and stability. Gold can experience initial liquidation pressure, but often recovers as investors begin to understand the monetary consequences of the crisis response. Commodities can be more complicated. Energy and agricultural commodities may fall initially if investors fear demand destruction, but they can recover if supply disruptions and monetary stimulus become more important. Equities usually do not recover evenly. The strongest businesses recover first. Companies with low leverage, strong free cash flow, or durable demand and healthy balance sheets tend to emerge in a better position. Weak companies do not. What gets destroyed in liquidity crises is also predictable. Leverage gets destroyed, illiquidity gets destroyed, complexity gets destroyed. Products that look clever in good times often become dangerous in bad times. Leveraged ETFs, yield-enhancing structures, highly engineered products, private vehicles with long lockups, funds that rely on marks rather than real liquidity, strategies that promise extra return without clearly explaining the hidden risk. These are the kinds of things that appear attractive when markets are calm and become toxic when liquidity disappears. In a crisis, simplicity is not conservative. Liquidity is not timid. Balance sheet quality is not boring. Those are the characteristics that allow you to survive and then act. Survival plus optionality is one of the most aggressive positions you can have when everyone else is trapped. Now, I want to bring this together. Every crisis is a wealth transfer. That may sound harsh, but it is true. Wealth does not simply vanish in a crisis. Ownership changes. Assets move from weak hands to strong hands, from the leveraged to the unleveraged, from the panicked to the prepared, from the reactive to the disciplined, from people who assumed the recent past would continue forever to people who understood that markets always contain risks that are not yet priced. The investors who lose the most in crises are not necessarily the ones who failed to predict the exact top or bottom. Nobody predicts those consistently. They lose because they had no framework. Here they were improvising under pressure. And when you improvise under pressure with real money at stake, your emotions usually make the decision for you. Fear tells you to sell when you should be evaluating. Hope tells you to hold when you should be reducing risk. Greed tells you to buy too early. Panic tells you to sell too late. A process protects you from that. A prepared investor does not need to know the future. A prepared investor knows which signals matter. A prepared investor knows what those signals mean. A prepared investor has already thought through possible scenarios before the crisis arrives. That is crucial. You want to make your crisis decisions before the crisis, not the exact trades, but the framework. You want to know in advance what will cause you to reduce risk. You want to know what will cause you to hold cash. You want to know what will cause you to deploy capital. You want to know which assets you want to own if forced selling creates opportunity. You want to know which assets you refuse to own because they are too leveraged, too illiquid, or too complex. Because when volatility is exploding and headlines are terrifying, your mind will not be clear. That is not a personal weakness. That is human nature. The advantage belongs to the person who prepared when conditions were calm. The three signals I have described are not guarantees. Credit market stress before equities react. The Fed shifting from inflation concern to financial stability concern. Forced selling and extreme positioning, creating mispriced assets. These are probability tools. They will not make you right every time. But they can help you avoid the catastrophic mistakes that destroy capital permanently. They can help you step back before the crowd understands the risk. They can help you avoid buying too early simply because the Fed sounds slightly more dovish. They can help you recognize the moment when panic-driven selling creates the opportunity to buy quality assets at extraordinary prices. That is the goal. Not perfection, preparation. The prepared investor does not need to be the smartest person in the market. The prepared investor needs liquidity, discipline, patience, and a process. That combination is rare. Most people want certainty. Markets do not provide certainty. They provide signals. Your job is to read them without emotion. When credit spreads widen, listen. When funding markets tighten, listen. When the Fed's language changes, do not celebrate too early. When the yield curve begins moving, understand what it is saying. When real rates become restrictive, understand what that means for leverage and speculative assets. When good assets are sold for no reason, ask whether the seller is forced. When positioning becomes extremely bearish, ask whether the market has already discounted the fear. And when everyone else needs liquidity, make sure you are not one of them. That is how crises become opportunities. Not because they are pleasant, they are not. Not because they are easy, they are not. But because disorder creates mispricing, and mispricing creates opportunity for investors who are prepared. I have never believed that the goal of investing is to avoid every loss. That is impossible. The goal is to avoid permanent impairment of capital and preserve the ability to act when the odds are favorable. That is why process matters more than prediction. Predictions make you feel smart. Process keeps you alive. Predictions get attention. Process builds wealth. Predictions are fragile. Process adapts. If you take nothing else from this, take this. Do not wait for the crisis to build your framework. Build it now. Know your signals. Know your liquidity. Know your risk. Know what you own. Know why you own it. Know what would make you change your mind. Because the moment always comes. Every cycle eventually produces stress. Every period of easy money eventually creates excess. Every excess eventually reveals who was prepared and who was simply lucky. And when that moment arrives, the market will not give you time to become disciplined. You will either already have the process or you will be forced to improvise. And improvisation under pressure is how capital gets destroyed. The investors who emerge stronger from crises are not calm because they feel no fear. They are calm because they already know what to do with the fear. They have seen the signals. They have respected the evidence. They have kept liquidity. They have avoided excessive leverage. They have refused unnecessary complexity. And when forced sellers arrive, they are ready. That is the mindset. That is the discipline, not prediction, process. Build the process, watch the signals, and when the opportunity comes disguised as panic, be prepared to act.